Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoy this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Matthew Jordan of Limitless Crypto Investments. Matthew, thank you for joining us.
Hey, Hall. Thanks for having me on here.
Great. So can you tell us a bit about your background? What did you do before your current role, and how did you get into your current role?
So my background was in developing healthcare solutions for doctors and patients, and basically got into it kind of like everybody else did. I bought my first Bitcoin in about 2015, wasn't really sure about the tech, just looked at it in terms of kind of having skin in the game. But in the healthcare side, you actually look at personal health records and electronic health records, and you see the platform and how doctors transact data, how it goes back and forth, which hospitals use what, and the network effect. And so that's when I come into the platform tokens in terms of these platforms like Ethereum, and they really caught my eye. And I took a deep dive into the technology. I really started to get behind it. I liked it. Started looking at some of the application tokens, looked at some of the application companies, and basically started the fund in August 2017, and we're here now.
Great. So tell us more about the crypto space and what role you're taking in there and what area you're currently working in. It's a very big space. There's a lot going on with blockchain and altcoins and other things, but what is the world you deal with?
So right now, basically the retail and interest is almost basically at an all-time low. And right now, it's, in my eyes, it's driving real content onto some of these platforms. So basically, everyone has come to realize is there's essentially these tokens aren't needed for each platform. So you look at the first ICO ever is Mastercoin, and basically it came to consensus and said that the token is absolutely useless. They actually developed what's called the Omni protocol, which is what Tether is built on. Has the second highest volume per day in terms of trading, other than Bitcoin. But right now, it's when you see the market and you look at it, it's no one has enterprise industrial applications building on top of their protocol. So regardless of how great your tech is, if nobody uses it, it's worthless. So that's what we're focused on, is kind of driving some of the connections, oil and gas and healthcare connections I have down here in Houston. It's showing them it's a lot more than Bitcoin. There's a lot more to the protocol layer on other applications that they can actually use and cut down some of their overhead and automate some of the transactions that they do on a day-to-day basis.
Well, very good. Well, we talked about where the industry is currently coming from. It's kind of at a low point right now. 2017 was exuberant high, and then people are coming off of that and getting back to a little bit more of the reality of building businesses that take time, of course. Where do you see it going in the next year as far as building businesses and that type of thing, as far as the blockchain crypto world?
In terms of going places, the only ones that are going to stay around, in my personal opinion, are the ones that have real content on them. If you look at like Red Hat, the reason Linux blew up, a lot of people use it, is because Red Hat went out there and promoted it. They put out the platform and they said, here are the applications we're going to use, but you have to pay us to use these. And so I don't know if people are familiar with the FAT protocol thesis. It's actually investing in the underlying technology of the internet rather than trying to pick through Google, Amazon, Apple, and all those companies. But until there's actual content, the value is going to accrue there. So you'll kind of see these platforms emerge that have real use cases, real companies driving them, have real business revenue, have real revenue models, and they're driving the platform usage.
And how many companies do you see actually achieving that today in the blockchain space? I've seen some blockchain companies struggling to get real revenue going because they're going to use a token, but the token's not live yet. And so we're talking to investors about user engagement and technology platforms and so forth. And in 2017, that was sufficient to raise funding. In 2018, that doesn't seem to be quite as sufficient anymore. Where do you see most companies at this point?
So if you look at the top 20 tokens or coins 2 years ago and you look at it now, you see it's totally different. So a lot of people are starting to realize these companies are only using their token for a form of fundraising. There's no actual, they're using it as a proprietary payment method. But then people come to realize there's no actual value in actually holding the token. So there's actually no need for it. And so these companies come in and then fork off the existing protocol and just use, or say, Ethereum or Bitcoin to process the payments on the network.
So tell us more about your fund and what is your investment thesis for it? Of course, you want content, but more specifically, what are you looking for?
So basically, we look at companies or projects that have the ability to disrupt real world technology, real world businesses, and basically remove the rent-seeking incumbents, basically the intermediaries, and what they can do and how they can provide and cut down some of the friction in terms of payments, data management, all along the lines of that.
And for those that are startups out there in the world of blockchain, which ones of those should be coming and knocking on your door? Do they have to achieve certain milestones or usage metrics or technical milestones in order to get into your fund, or is it completely open?
So basically, we are an early stage technology investment firm, but we are tailored towards blockchain technology, and it comes down to three main principles. In our eyes, it's permissionless, and then it's decentralized, so it's either censorship resistant. If they're not a single point of failure, can someone just come out, take the platform underneath you? And then it's also trustless, because once you notice and you see, the reason we have the legal system we have today is there's a trust problem, and everybody sues everybody here. And that is our main investment thesis based off three primary principles.
Well, I've noticed a number of quote-unquote blockchain solutions coming out, and then when you dig down into it, it's really a centralized system because it's easy to build and you can prove it out and you can work on the domain, and there's a little bit of the decentralization starting to come into it, but it's not a pure decentralized solution. What do you think about the go-to-market strategy of companies today that do that versus those that take a pure blockchain decentralized solution from day one?
So in terms of decentralization, you look at it, can the existing protocol go on if the founders were to disappear? And so that's when I say decentralized, not one person can take that out from underneath you. And so you look at it, Charlie Lee, who's the founder of Litecoin. If something terrible was to happen, that he was to die tomorrow, the Litecoin protocol would actually go on. So in terms of being decentralized, yes, there's people building on top of the protocol, developing improvements for it and everything, but there's not a single point of failure. So that's what I mean by decentralized.
And what are the challenges in creating a system at that level that's truly trustless, permissionless, et cetera? What are the issues you see people coming up with and trying to build those out with today's tools and technologies?
So right now, it's mainly towards the network value. In terms of the network effect, is a lot of these companies now, they don't have a firm go-to-market strategy. So it's a lot harder to gain the network effect than it is to have the greatest tech. And so they can pivot off their existing technology. They can fork it. They can add upgrades. But in terms of getting people on your platform, developing it, using it, what's your network like? What's your developer community like? This is what drives the network effect. And that is what a lot of protocols and applications are going to have trouble with here in the future.
I've talked to several people who help build out blockchain-based systems, and a common theme among them is they talk about building out your community from day one. Early on, who is going to be your community, who's going to be the users, and from the get-go, they're a central part of everything. Testing, building, investing, funding, all of that happens. How does one build out that or get that network effect going or start to build that community very early on?
So the reason the blockchain community has taken off in the way it has and its parabolic growth is open source platforms have been around for a very long time, but Bitcoin has actually given it a way to monetize, and these other platforms is incentivize users and developers to build on top of the platform. So when you look at it and you see the growth that's happened, it's why are people building on the platform? Oh, they're incentivized monetarily. So that would contribute to the growth. And so if there's no real incentive to build on top of it, there's nothing will be there. No one will come to it. No one will use you.
So from an investment side, you're looking at these new opportunities coming in. There's many risks that go with the startup, regulatory, technical, execution, etc. What are the top risks you worry about when you look at these deals?
So for the risks that we look at are an execution standpoint. Can they do what they say? And so the main thing is their runway in terms of, because they're all foundation based. They are not, a lot of these companies, you take out basically revenue, you take out cash flow, you take out all these. And so basically they're relying on token appreciation to build out their platform. So one of the biggest risks also is regulatory risk. In my opinion, I personally think the U.S. is far behind some of these other countries and how they're welcoming the crypto society. You see South Korea, their advancements in technology are just far surpassed the United States.
So execution is one of the biggest ones, and then the governments that go behind it are a big issue as well. When do you think the next phase of or evolution is going to be of startups? We've heard a lot about blockchain solutions, but not many are really on the market running, engaging users, and monetizing just yet. There's some good examples that are, but a lot are not. And when do you think we'll actually see people actually getting out and having real users and real technology that we can actually put value to?
So right now, the main course of action for a lot of these blockchain is security token offerings. And the biggest attribute blockchain is capital formation, the ability to have a global reach of your capital formation and do a public fundraising. So when you have the ability to, because lots of startups die from lack of funding. And so when these startups have the ability to go receive funds from Asia, Korea, Europe, it creates a whole new opportunity. And so the next run, in my opinion, we're going to have is going to be in the security token offerings where they have actual equity. And that's why you see these startups raising so much money, because in a sense, they're not really giving any equity. They're not giving anything away. They're giving a token that on paper is worth $1, $10, but in reality, it's not liquid. So it's worth nothing until someone else is actually buying it. So when you look at that, it's basically price is the final arbiter, and the token appreciation grows with the network. And if no one's on there, no one wants to buy your token. So you're the last one holding the bag.
Well, I saw this at SEC, how they handle the crowdfunding laws, Title III. It took them 3.5 years to figure out the FINRA-specific rules for regulating it, where you can actually go and implement a crowdfunding portal. 3.5 years seemed to be a long time. Do you think we're going to be getting through 2 utility tokens and separating out what's a security and what's a utility any faster than that? Or do you think we're in for the 3-year wait and see like we did last time?
So the SEC is very tentative on what to do. They've already declared Bitcoin not a security, and they've deemed Ethereum, it's already enough decentralized. It started out, and so it started out as a security, but now it's a utility token. So you see the SEC kind of caught in the middle between, okay, can a security morph into a utility token? Is it a utility token that can morph into a security? So I do think it'll take, if not 3 years at minimum, for the SEC to finally come out and garner their sanctions on every single one of these tokens that are coming out.
What do you think about SAF launches, where safe note for tokens, where it's a security today, but as soon as the system's working and people can actually use it, it can become a utility? What's your take on that approach to that quandary of trying to get a token out there through the current laws?
So there's 2 types of SAF agreements. There's actually 3. So there's a SAFE, which is simple agreement of future equity, which is what just traditional startups do. And then there's a SAFT, which is simple agreement for future tokens. And that is basically just so they don't have any regulatory concerns and they're only selling to accredited investors. And then the next thing is what we're seeing is simple agreement for future tokenized equity. So, and that is the same thing as a SAFE. The only thing is it garners liquidity and kind of mitigates your risk in taking out the traditional 5 to 7 year lockout where there's absolutely no liquidity. Your investment might be worth $10 million, but there's no liquidity. And so when you're able to fractionalize a portion of your company and generate liquidity, it mitigates the risk for some of these VC funds and us as well.
All right. Well, good. We often miss things along the way, but glad we did cover everything. How best for the audience to get back in touch with you?
Best way to get in touch with me is So our website is www.limitlesscryptos.com. You can also reach me at mj@limitlesscryptos.com or connect with me on LinkedIn. Happy to share our thoughts and figure out a way we can collaborate.
Well, great. We'll put that in the show notes and look to have you back for an update, as it is a fast-changing industry and things will be different in 6 months, I'm sure. And love to hear more about your thoughts as to where it's going. With that, we'll close it out.
Sounds good. Thanks for having me.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.